Two, four. Hi, everyone. Since folks often aren't exactly punctual, I'm going to wait about a minute to get started. So we will get started 1 or 2 minutes in. All right. Thank you, everyone who is joining us today. We have an incredible webinar that we're delighted to present. We're going to be talking about the opportunity for agri-tech investment in Southeast and South Asia. This is something that Omnivore is very passionate about. Obviously, we are the most active agri-tech investor in India. But over the years, along with many of our LPs, we've begun looking at, effectively the near abroad, the ecosystems that exist in Southeast Asia, the ecosystems that exist in the countries of the SAARC surrounding India, trying to understand if what we've experienced with agri-tech in India can be extended into those regions, and what the nuances are for the agri-tech, agri-food, and agribusiness ecosystems in those countries. Now, this has not been a blind exercise. Some of what we've seen in the last few years has been both interesting and distressing. I think many people are aware of the blow-ups in the Indonesian ecosystem, e-fishery being the best known amongst them. But there have been challenges in many of these geographies. There have also been challenges in India, for that matter. And so we wanted to do a deep dive into both the opportunity set and the problems, and to help shape a clear understanding of what investors looking to deploy capital in these regions would be faced with. Now, we didn't do this alone. We worked on this with sponsorship from two of our LPs, FMO Ventures and the IFC, and with additional sponsorship from the Rabo Foundation. And as we did this work, we worked with two excellent third parties, with Beanstalk and with Brighter. Beanstalk having incredible sector expertise and regional expertise in Southeast Asian agri-food and agri-tech, and Brighter being masters of the data operating across the global South, and having worked deeply in the past on sort of the agri-food investing ecosystem in emerging markets. And so today we're going to share those findings. The team from Beanstalk and Brighter will jointly share those findings, and then we're going to have an incredible panel which will be moderated by Maurice from FMO Ventures, with many of the leading participants from the investing side of the table in Southeast Asia. So with no further ado, let's go ahead and get started and have the team from Beanstalk and Brighter present. Over to you guys.
Thank you, Mark, for the introduction, for getting us started, and of course for your generous guidance and support throughout this effort. So firstly, before we get started, I'll introduce myself. My name is Justin Ahmed. I'm a director at Beanstalk AgTech. We're a ventures and advisory firm that's dedicated to a more sustainable, resilient food system. I'll be presenting alongside my colleague David Saunders from Brighter. I want to acknowledge and thank the various partners that have contributed to this effort, to IFC, to FMO Ventures, to Rabo Foundation, who provided critical support and expertise along the way. Of course, thank you to Omnivore, who's been steering the ship from the outset, and Brighter, who brought a new level of rigor to agri-tech investment data in the region. I also want to recognize Anjin, in particular the managing director, David Sukasing, who provided some invaluable advice and guidance with respect to our deep diving into Indonesia. So as Mark had mentioned, this has been the culmination of several months worth of research. We've been fortunate enough to benefit from direct engagement interviews with many leading investors, thought leaders, practitioners in this space. And thanks to all of you, I know some of you are here today. A bit about our approach to all of this. I'll start a little bit with what we didn't want to do. This is not, meant to be a puff piece or a takedown or a scapegoat exercise. This isn't about promoting or condemning an investment vertical, about profiles of singular success and failures. It's not even about the entirety of the capital stack. We didn't want to look at tech in the vacuum, and instead really sought to ground it in the broader industry landscape that shapes it. We did aim to give a frank and honest perspective on the real challenges that the space at large across Southeast and South Asia has seen in the past half decade, and offer a targeted perspective on where venture capital investors, in particular, should be looking to see a different half decade ahead. So to do that, we took a step back from AgriTech, firstly to agriculture, to agribusiness and the policy landscape, and to the venture capital landscape. So we'll walk first through some of the sector fundamentals that we see are shaping and constraining investment opportunities in the space. Then we'll go to the evolution of venture capital in the region, before we get to Brighter's hard-hitting analysis on the shape of AgriTech investment in particular, and our collective perspectives on the markets and segments which show promise to us. Okay, so getting right into it, because we're only going to be moving through the highlights of our report tonight, I wanted to start with a bit of an executive summary of our findings writ large. I promise this will be the most text-intensive slide we have in this show. At the highest level, despite the underlying fundamental demographic and industry growth drivers that really signal opportunities for the region's agritech space, the early experience of VC-backed agritech has been relatively stunted and concentrated, I think, to say the least. The Southeast Asia and South Asia region that we're looking at outside of India is not the engine in some ways that India or perhaps Sub-Saharan Africa has been from an agritech perspective. There's been a much smaller and more fragmented funnel of opportunity over the last 5 years to start with. Excitement from a peak in 2022 has fizzled a bit. Investments down well over 60% since that point, and no doubt the exit landscape has not been extremely promising. Less than 10 exits seen overall, mainly food rather than agri, and primarily distressed assets. So we look to the industry dynamics and experience of AgTech to help us unpack this. At the industry level, our assessment is there's been a lot of focus and powder blown on some of the hardest to reach segments, and some overblowing and overhyping of the regional opportunity. That sense, I'll use the word regional. At the venture level, there's been a lot of learning and reorientation happening. A real refocus on getting unit economics right before thinking about scale, foregoing direct to farmer pathways, showing more constraint in cross-border growth, which has been challenging to say the least. And there are a few things that we think investors can immediately take into account as they progress. First, aligning around corporate-led opportunities. Corporate agribusinesses, strategics are already the main liquidity engine for the region, for AgTech in the region. 3 times more acquisitions from local rather than foreign companies. So really domestic agribusiness and regional agribusiness. They engage early and partner in a range of models, and really are the early champions of AgTech in this space. And banks and financial institutions are a really important part of that story. Our second big reflection is that this region is likely to be much less about unicorn hunting. In some ways, it's about getting in earlier, targeting strategic exit pathways earlier. We think that fragmentation of scale, in some ways that we'll get into later, is going to constrain, in some ways, massive exits, and that better scaling opportunities exist through corporate strategic ecosystem. And so for investors, about hopefully minimizing dilution and identifying strategic exit pathways from day one. And thirdly, we think patient capital, which is already shifting and showing some promise in the region, is going to be a big point of alignment and importance in this region. Heavier and more resilient role of semi-commercial and commercial lenders, and particularly scaling support through blended and publicly supported models. So all that said, we're bullish on a range of subsegments with in these investment thematics in focus we see on our right, and we'll get into that as we go. And despite the hype and trough cycle, we're still quite bullish on aquaculture as a regional scale opportunity. So we'll talk about that. But I wanted to start with the agri-sector fundamentals. So, here we really explored the size and scale of agriculture as a segment across the region and the systemic constraints and the structural realities that really shape venture possibilities across these distinct markets. So, we see a lot of opportunity, but mostly localized, single market centric. I think it's non-trivial to scale broadly. For the most part, I think we'll talk about how do we dismantle this quote regional opportunity and speak more cleanly to where real challenges and solutions exist. We believe strongly in the underlying drivers of venture and impact opportunities in the agri-tech space from the perspectives of, firstly, basic productivity improvement, secondly, premiumization and value addition, and the expansion of new revenue categories like climate and offset markets and the like. But just wanted to share a few highlights that we feel get the point across and will help you think about the region a little bit differently. So in most of Southeast and South Asia, agricultural productivity is still perhaps the most obvious and important source of value creation. So at a baseline, we're looking at, for most commodities, somewhere between a 2 to 6 times gap between producers in the region versus global benchmarks. So comparing where actually regional producers sit relative to the benchmark of the top 3 producers by yield in the globe. That's a huge room for uplift. And I think that's where we know that farmers often make a lot of their decisions around where upside opportunity sits. So in some ways it sounds obvious, but it's important to actually disaggregate where this sits, where this doesn't. Vietnam, you can see, is among the leading producers from a yield perspective in coffee. So, this does not sit the same everywhere. That's all about practices, inputs, informations, post-harvest management. But really, it's about enterprise solutions that can help to package, integrate, and scale that as an approach. So it's something to focus on. Second piece I wanted to talk about is about regional fragmentation. So here we're looking at the proportion of global production that comes from this Southeast and South Asia region and the markets within it. And I think what really gets lost often in the global discussion is how the aggregate might misrepresent the opportunity in both positive and negative ways. So, very few crops are truly regional. I think when we look at things like pineapple, rice, cassava, cashews, they make the actual production is spread across the region and relatively small share of global production. It's going to be really hard to play at a venture scale in these value chains without a regional play. That's challenging because we've seen in our own investigations that about 60% of cross-border deployments in AgriTech have failed. There's lots of reasons for that, but something to take in mind. Mostly, these are not regional markets. There's usually only 1 to 2 countries that really matter. Coffee, that's all Vietnam and Indonesia. Palm, Indonesia, Malaysia. So it's important to recognize that often we're talking about regional scale opportunity, but really talking about national markets. That has a counterpoint where obviously national markets might be big enough to play and scale in. Indonesia is 74% of the cloves market, all their own. Malaysia and mustard. These are $200+ million markets that do matter on a global scale. Cambodia's dominance in cinnamon, pepper, and coir all speak to actually at scale opportunities that might be hidden in plain sight, clouded by the lack of a quote regional scale play. So another kind of angle to how we think about and probably dismantle in some ways this idea of one single unified regional market. The other lens through which we looked through what are actually venture opportunities is through where profit pools sit. In the end, that's what value capture is about. Where are unit economics actually driving tech investment opportunity? depending on the unique value proposition of a particular solution, the opportunity and the incentives to drive adoption really depends on the intensity of margin pressure or the space to spend. And there's not a monolithic pattern to this across industries or across the agricultural space in the region. In Vietnamese coffee, the largest take of that profit is upstream with producers who are, as we spoke to in the production productivity slide, are highly productive, relatively organized, accessing certified premium, quality differentiated. Filipino coconuts, much more fragmented. Traders and millers are a substantial part of the chain, but add relatively little value addition until you're getting into small market, hyper premium coconut sugars and the like. For Vietnamese shrimp farming, it's a small number of processors that capture the largest share of the value, hyper efficient, globally sophisticated, and export oriented corporate agribusinesses. So, important for us to be able to really reflect when we're kind of refragmenting and reframing what the venture opportunity looks like in AgriTech is understanding the value chain, the market, and the ecosystem in which we're playing and how actually profit flows constrains or unlocks that. So those are a few reflections on the ag fundamental side. I'm going to hand over to my colleague at Brighter, David Saunders, who will talk us through the different waves of agritech and venture capital that we've been observing over the last 5 years.
Thanks so much, Justin. And just bear with us for a second as we do this a little switch in terms of the screens. Great. So yes, let me make sure it's seeing. Everybody can see that okay? Nope. So as Justin was saying, my name is David Saunders. I work at Brighter Bridges. We are a data and intelligence company working across emerging markets. We track funding flows into innovation ecosystems. And so for this particular study, okay, I'm saying that you can't see the actual screen, so let me do it again. That should be good now. Okay. Yeah, thanks so much, Justin and everybody, for the introductions. And thank you very much again to the partners, Omnivore, Rabo Foundation, IFC, and FMO Ventures. Yeah, I think this was a really interesting study for us. So we have been working in the agri-tech space for the last 4 years, tracking funding flows across emerging markets. And over that time, we've really seen some big changes in the landscape. And I think probably no better region reflects those changes than what we saw in Southeast Asia. And in this presentation, what we're going to show you for the next few slides is both how the agri-tech space has evolved in Southeast Asia, but also how this has evolved against the backdrop of the wider venture capital space. So at Brighter, we don't just look at agri-tech data. We look at funding into all types of innovation, ecosystems, and startups. I think one of the big things that Omnivore and Mark pushed us on, but also you've heard from the feedback from Justin, was we don't want to look at agri-tech in a vacuum. We want to look at it within the context in which it evolves. So both against the backdrop of the agricultural sector, but also against the backdrop of the wider venture capital sector as well. So just before I get started, I want to just share with you all the sample that we'll be showing data from over the next 7 or 8 slides. So the data set we have, as I was saying, covers both agri-tech data, but also data on all the sectors as well. It's really focused from 2020 to 2025. So particularly as we've seen this kind of run up in VC and agri-tech funding, and then as we've seen the correction and what things look like now. And then we've also looked at the wider sample in the region. And we really zoomed in on 4 key markets where we have really strong data: Indonesia, Singapore, Vietnam, and Philippines. And I think those markets represent more than 60 or 70% of the wider agri-tech and venture capital landscape over that period. And they also show some really interesting telltale signs about how this VC ecosystem evolved, and the AgriTech ecosystem on the back of that, and how things have changed over the last few years. So before showing you the data, we also just want to show you the category of solutions that we include in AgriTech, because it's relatively broad. We're not just speaking about digital agricultural solutions or agricultural platforms or marketplaces. We're looking at inclusive fintech and those financing solutions that support agri SMEs and farmers. We look at digital value chains. I think this is what a lot is most commonly associated with AgriTech as well, which are the platforms that support everything from production to aggregations to logistics traceability. We've seen a lot of that, a lot of funding and momentum in Southeast Asia around those types of solutions. We also include emerging technologies. So here, for example, you think about new trends we've seen related to biotech and robotics, but also some of the innovations we've seen on AI and remote sensing within the agri-tech space. So think really the frontier and deep technologies that are being applied to the agri-food systems. And then lastly, we look at sustainable or consumer-facing brands. And this has been quite interesting as well as in the region, and we'll get into how we've seen these holding up. But this is really where the central value proposition is how food is ultimately being made sustainable or sourced or nutritious, and particularly focusing on consumers either directly or through businesses. And here you talk about innovative food and beverages companies like we've seen Oatside in Singapore or For Coffee, for example, in Indonesia. So the first thing we want to kind of step back and say is, how has the wider venture capital ecosystem changed over the last 6 years? So as you can see here, we have this big kind of run up in funding from 2020 to 2022. This is not a uniquely Southeast Asian story. We've seen it around the world, across emerging markets as well. And you see this very pretty blue color here called logistics, being one of kind of the major areas that was attracting funding in the region, where we saw VC and startups trying to target and address a lot of different problems. But as we've seen in Southeast Asia, as we've seen in many other markets, we saw a big correction beginning in the end of 2022 and particularly starting in 2023, as VC markets around the world began to go through this correction phase and kind of ending of this boom cycle that we had been through. And in Southeast Asia, we've seen over the last 3 years since that correction, a new baseline, a little bit of stability, a little bit of growth over the last couple of years. But really, this has been backed by a few really big deals, which I think are masking some of the slowing momentum and slowing deal activity that we've seen in the region. If we then look at the agri-tech sector and we zoom in that, I think what's been interesting is if you then compare it against the VC data we showed, that initially in 2023, there is a slower correction than what we saw in the wider VC space. And this, I think, initially led to a view that actually, agri-tech was holding up better. There is still a big deal into companies like eFishery. We're seeing some more kind of resilience within the sector. But really, I think these handful of large transactions that were sustaining the funding within the agri-tech space were actually masking continued weakening in the sector. And what we've seen over the last 3 years is that, as opposed to the VC space, where there was an initial very steep correction and then kind of a gradual baseline and gradual stabilization, we've actually seen this continuing decline in funding and deals year over year. And I think what's quite interesting around this is when we look a little bit more into where this correction has happened, it has not been maybe as consistent across all those different solution categories that we were speaking about at the beginning. We've really seen the most pronounced correction happening in digital value chains and digital platforms. I'm not saying that all other of the categories have been resilient. As you can see here, inclusive fintech has had some hit or misses similar to digital value chains, with some of those deals, being driven by single deals. But you particularly see the sustainable brands and the consumer-facing brands being more resilient. And while emerging technologies has shown a correction from 2022 and 2025, over the last few years, it's been more resilient as well. So, what we've really seen, if you remember that first slide I showed you, kind of that run up in VC funding, that steep correction, bit of a stable baseline. You saw that kind of light blue logistics, just kind of asset heavy businesses really being hit hard through this correction. What we've seen in the agri-tech space, right, is a similar kind of boom and bust cycle, but not yet a new baseline or yet a more stable recovery. And when we look at this slide, we see that a big part of what has driven that has really been the digital value chains, and to an extent, the inclusive fintech type of solutions. And we'll get into why we think that might have been the case. And I think, as we were speaking about at the beginning, not all the markets have necessarily been hit the same way because not all the markets grew the same way. The initial kind of markets that saw the most funding being attracted over, particularly that 2020 to 2023 run up, were really Indonesia and Singapore. And market that we've done a lot of work in ourselves at Brighter. In Nigeria, for example, we saw a similar phenomenon where there was attractiveness of a lot of scale, a lot of funding entering the space on the back of that, particularly backed by VCs as well. Singapore was the other market that saw lots of funding, but a very different type of funding, not as much the digital value chains, kind of the digital platforms type of play, but more the deeper tech and sustainable brands. And, particularly on the latter, on the sustainable brands, you have high incomes, you have demand for sustainably sourced products, both for Singaporeans, but also a place where they can do lots of processing for the rest of the region. And then when you look at the Philippines and Vietnam, I think what was quite interesting there as well, it hadn't attracted as much funding as the other two markets. We had seen at least one or two kind of mega deals within those areas that had driven a lot of that funding, but the type of funding looked more similar to Indonesia, again, with this bigger emphasis on digitalization, aggregating up existing agricultural activities, trying to improve productivity, logistics, transport, trying to feed those either into domestic or export value chains, as Justin was speaking about before. And, if you're following the story well so far, I think one of the big pieces you can kind of take away from what we're saying is that a large part of the slowdown and a large part of the correction that we've seen within Southeast Asia has been an Indonesia story. And there probably is some, fact to that, the markets that we're really prioritizing here, Indonesia, Singapore, Vietnam, and Philippines, probably make that more stark. I think if you speak to a lot of people that were looking at the region at the time, Indonesia looked like a promising market. It had a lot of big deals going into companies like e-fisheries, for example. And as quickly as it's gone up, it seems to have quickly gone down. And that combination, particularly of very large deals, digital value chains, has been one of the places that we've seen be particularly hit over the last few years, where, for example, Singapore, to an extent, held up better, particularly in 2024. 2025, I think we haven't seen as much activity. And then if we look at the Philippines or Vietnam, where it seems like there's resilience, it's really driven by one or two mega deals. So, for example, in the case of the Philippines, Met Logistics, a big cold chain manufacturer, and in Vietnam, Tech Coop. So I think we've really seen this kind of correction within that kind of big, digital play, big markets, venture-backed solutions space. And when you look at the data in terms of where a lot of these big deals were going into that as well, you see that while less than 10% of the funded agri-tech companies in Indonesia raised over $50 million, the majority of those were concentrated in Indonesia. So you had this big kind of run up in funding, lots of big deals, lots of late stage capital, lots of betting on digital agriculture in Vietnam. And then as we've seen, as fast as it's gone up, we've seen that correction also coming down. I think to an extent, one of the things we picked up in our research as well is that has shaped both wider VC trends in Indonesia, but also some of the wider agri-tech trends in the region. And I think a big reason for this is that, big funding rounds were just not a guarantee for success. A lot of the types of models that were supported in Indonesia, and this isn't just an Indonesia story, we've seen this in a number of countries across emerging markets, weren't necessarily the appropriate models for the type of capital that was going into them. A lot of these were capital intensive businesses. They started as trying to solve a specific issue like an IoT feeder into fisheries in Indonesia. And then they grew out from that, having to, build logistics, having to add on. And that became very capital intensive. And if you pair that with the fact, if you pair that with the fact that a lot of the backers of these companies were also foreign late stage capital as well, who didn't know the region as well, there was this combination of a very capital intensive business amplified by expectations coming from foreign VCs that at times led to certain governance and risks associated with the speed at which they were trying to get to scale. And you saw this across a number of these kind of big digital businesses, whether it was eFishery, whether it was Tiny Hub. You had this asset heavy, low margin business trying to go very, very fast with venture capital money. And one of the slides we don't have in here, but which we have in the report is a big gap that we often see in the market is diversification of the types of funding instruments available to support these types of this type of growth, which isn't always perfectly matched with the expectations of venture capital. And a lot of times they were ending up using venture equity for solutions that would have been better supported by working capital. And, outside of those, asset heavy marketplaces where scaling beyond their unit economics, being forced to grow too quickly, we also saw some of the risks associated with trying to target also just inclusive fintech with similar types of financial backing, where you have high credit risk, high kind of cost of field operations to go and acquire new clients. And when you're kind of not yet right on your own unit economics, these are high risk businesses, low margin, capital intensive with VC expectations. We saw a lot of these big funding rounds didn't necessarily lead to that success. I think what's been quite interesting for us as well is, to an extent, then a lot of what we've seen is that kind of late stage funders really feeling burned. I think since 2022, particularly with some of those very big deals, particularly for some of those foreign corporates or Ps that came in, tried to scale and push some of those companies that we've been speaking about earlier. And we've seen a bit of a shift in the type of funder mix now that's creating some of the conditions that we saw earlier. So it really hasn't been the VCs who have been the ones that have, reduce their share of activity or momentum in the region. Well, we've seen a drop off in all categories. Particularly in the last year, we've seen them be relatively active still, driving most of the deals, particularly at the kind of Series A stage. The correction that we've really seen has been in the late stage funding, where Ps or corporates used to step in and play that role in helping scale up those businesses. And what we've seen have replaced a number of those types of investors over the last few years has been the entrance of more impact investors, DFIs, banks, and to an extent, both local and foreign governments. And with them comes a different set of funding, a different set of funding instruments that are also now shaping the landscape. So I think this combination, right, that I really want to get across, that we've seen over the last 6 years in the market, and what we've seen from the data, is really how this kind of funding downturn didn't just result in less funding. I think it's really led to a structural shift in the marketplace. The first kind of phase of funding was really driven by VC funding, going into places where maybe it shouldn't have at certain times, or at least some of the later stage, bigger equity funders stepping in, trying to scale things before they necessarily had the right unit economics, not necessarily being aware of some of the unique context of the markets they were operating in. And I think what we saw, particularly after 2022, because, in some of the reports you'll read, AgriTech was still looking good within Southeast Asia in 2023, was it was really just a few large deals that were masking, the real slowdown that we were seeing that has really landed in 2025. I think as we've seen this funder mix shift, we've seen more gaps than emerging in this kind of scale up funding. So if we look at our data, which you'll see in the reports, we've seen Series A holding up better than we've seen, obviously, Series B plus, where we've seen the biggest kind of correction of funding happening as well. And that's really as we've seen P and corporates pull back and looking at other types of funders that can come in and play that role. And that's obviously then slowing some of that volume of funding we've seen. But on the other side, I think with the Series A and kind of the VC funders, we're also seeing them be more selective with the investments they're making. Fewer deals are getting done. Capital is flowing to business models that they think work, where there are proven unit economics. There's this lower capital intensity. I think it's raising the bar for what many ventures need in order to attract funding, and leaving many kind of stuck, unable to necessarily scale or reach that next follow-on round. I think the other thing that I really want to kind of get across in the data analysis that we've done is that, it's not just about funding, right? And I think everybody's been saying this, and you see a lot of divergence around business models and these assets. Well, I only had time to show you some of the ones that weren't as successful, which were the asset heavy, capital intensive business models, particularly linked with logistics. We did see successes in more asset lights, not consumer but business focused models. So I think there still is a playbook, and I think Justin will show that for where VCs particularly can still be active. And I also want to make the point that a lot of what we saw in that run up and that kind of correction were a handful of really really big deals that maybe didn't always have the best type of funding match for the business model they were at. And as I hand back over to Justin, I think what he's really going to emphasize and we really want to get away is, looking at a broader playbook to really support ag techs in the region. It's not just about lack of capital, right? It's also about making sure you have the right capital for the right type of businesses. How do we layer that in across different needs of the business as well? And how do we make sure that the type of funding coming in is aligned with the realities of the markets and the realities of the solutions, so we're not pushing people to grow and create risks where they're not necessarily required. So I think, Justin, with that, at the time, I'll hand back to you to explain what that new playbook can look like. And I've painted a little bit more of the gloomy picture. You can now look at where we're seeing the positive opportunities. Thanks so much.
Thanks, David. And yeah, that was the intention behind this presentation, was a bit of gloom, then gloom, and then the return. So let's see how that goes. But so thanks, David. I think what David spoke to is a lot of, obviously, what have we been seeing? What have we been seeing shift over the last 5 years, and where I think the same way that we talked about in the ag and agricultural landscape, looking at an aggregate scale, sometimes actually massive is going on underneath. I think just speaking to the actually venture capital space and talking about how some of the movements in the largest deals is maybe pointing to where the trends are missing underneath is a really important analog to miss. But we wanted to point to, but we wanted to move in this next section, say where are we seeing opportunities? Where are we actually bullish on in the future? What does that look like today and in the near future for venture capital? And a few of the things that are giving us confidence is the steady density of startups that are solving real problems and learning from the challenges of the past. So, and we talked about a different type of go-to-market approach, away from the direct-to-farmer opportunities, pinpointing in on corporate and strategic pain points, playing to an asset-light opportunity and showing more discretion around capital that they're engaging with and taking on. I think really important points. We are still bullish on aquaculture or at least that it represents uniquely for the region an actual regional play in some ways. And I want to talk a little bit about that. And we see that their markets developing their own distinct strengths. I think what we won't get into in these slides, but I really want to invite you to get into the report and understand and engage with is, really our hypothesis that policy, corporate conduct, especially the way that the impact space plays in this environment, is going to play a big role in determining winners in this ecosystem from a market perspective and from a player perspective, not just tech or capital. So really important to understand those and how they're evolving. What we wanted to show here is just turning our reflections back to the fragmentation of opportunity that we emphasized in that first section of the report. In this chart, we're outlining where we see the opportunity for venture capital enabled AgriTech is greatest by market, by vertical, by value chain. So today, and how it's shifting over the next few years or so. So, firstly, as we covered in the agri and venture capital sections previous, for us, there really is no uniform regional story in a sense here. Every market has its own distinct profile. So Vietnam is probably the market in which today we have the most well-rounded pool of confidence and the breadth of VC-backed agritech opportunity. We see it as an emerging leader in compliance-linked digital value chains that's really driven by export intensity, and a government that's been actively driving both traceability, premium opportunities, and digital infrastructure through programs like the Million Hectare Rice Initiative. Indonesia, for us, is still very clearly the largest near-side opportunities, just driven by the scale of the scale and shift in demographic and economic opportunity, with a lot of movement and still credible growth in the agri-fintech space and an increasingly large premium consumer ecosystem that we believe in. The Philippines, a second wave market, cold chain digital platforms and embedded finance are really seeing themselves start to deepen, driven by corporate demand and corporate investment in more plantation and in state-driven crops. And Singapore, as perhaps always, plays to the beat of its own drum in some ways. This obviously very in only light ways is a domestic market play, but a really credible regional deep tech and brand commercialization hub that has been increasingly focused on orientation towards partnership within the region. I think what was interesting for us in some ways is actually just even South Asia on this map, that it's there in a way that it might not have been a few years ago, and particularly given some geopolitical challenges across the region today. We see building on top of, for example, really strong social infrastructural foundations that Bangladesh has pretty emerged with a strong digital ecosystem, a growing backbone for agri-fintech, and a pretty rich in interesting opportunity aquacultural ecosystem. So they're on a trajectory here on this map. Virtually across every market, digital value chains and fintech show up as the highest confidence opportunity categories for the near term. But there's a cluster, not just in Singapore, but in Vietnam, Malaysia, and Thailand, which stand out for the depth of deep tech ecosystems and the scale of investment that both private companies, but also especially public ecosystems, are really pushed into the agricultural technology space, building off of relatively strong bases and health in other sectors and a really strong STEM workforce, both domestically and foreign fueled. And from a value chain perspective, you can see that in our view, it's still really aquaculture that stands out uniquely as a regional scale opportunity. So that's a $26 billion market that's rooted in domestic resources, strong export demand, local climatic advantage in many ways, regional scale and concentration of both production and demand. We think a lot of these spaces, those ventures are going to look, that are bridging biology and technology, are likely to look more like agribusinesses in some ways rather than tech ventures, and are going to have growth curves that probably accompany that. But speaks to the particular challenge that we talked about in terms of whether there's really unicorn scale opportunities and what really sustainable opportunities look like here. We think there are a lot of specific challenge statements there that hold legs and are common across markets, whether it's the budget intensity of relatively energy intensive feed, appallingly low feed conversion ratios, really challenging seed stock survival rates, less than 50% in traditional systems, and increasingly in premium demanded, quote, ecological systems, 10-15%. I think seaweed is an increasingly capturable and opportunity for the region. Less than 1% of suitable areas for seaweed cultivation are currently being utilized, and it's all selling at a price point well below Northeast Asian peers, with very limited processing capability and tech intensity. That's where we see corporates being most aggressive. So Thai Union, great example of that, and really focus on building an ecosystem around value addition here in seaweeds through bioplastics, additives, biostimulants, functional ingredients, collagen, and much more. So wanted to take the opportunity before we hand over just to deep dive into a few of the investment verticals that you can dig into deeper in the report. So digital value chains, again, this is where we think we're going to see the broadest, if not the largest growth opportunity. This is a space where Indonesian, Vietnamese, especially digital policies and investment in digital public infrastructure are really bearing fruit today. And they're seeing a lot of alignment in the rails that support these ecosystems extremely strong. Obviously, with the advent of generative AI, I mean, challenges and opportunities both in that space, but has been increasing the focus of corporate agribusinesses and banks in terms of how they engage with this segment. And maybe most significantly for particularly export-oriented sectors like Vietnam, is the regulatory pull that's from global trade policies and commodity-driven standards, so EUDR, RSPO, ASEAN's digital integration. I think this is going to be most significant in the animal agriculture and plantation or estate crops for the time being, but probably the broadest based opportunity that we see. In the inclusive fintech tech space, we see this as a space that's going to be concentrated and localized in a few distinct ecosystems that have very different regulatory frameworks and financial systems. But what's been really interesting here has been, as David pointed to in the funder mix, has been the level of activity and engagements by banks and by P2P lenders and financial services providers in general, who have been really increasingly the leading edge of engaging with agri-tech opportunities in the region. And are really underwriting opportunities to pilot and scale new differentiated opportunities in this space, whether that's around export and trade-linked credit schemes or outside of credit, insurance, and that we've seen actually getting real traction in a couple of different markets. On the sustainable brand side, largely consumer-facing agri-food, this is obviously where the strongest opportunity in some ways has been seen, and the strongest baseline for venture-backed agri-tech has been. Across Southeast Asia, we're looking at 40% growth in regional food demand over the next 10 years, particularly with aspirational values and health-sensitive consumer class. There's a hyper focus from regional corporates on innovation partnerships and equity investments in three specific spaces that we've seen, really around functional ingredients for health and wellness, around premium procurement for their own value chain integration, and byproduct valorization. And I know we noted those small number of exits that we have seen in this space. All of the exits that we'd observed, perhaps all but one, have been in this sustainable brands space. And I think we were surprised ourselves in some ways by our own bullishness in the case of emerging technologies. I mean, obviously, there's the big challenge here is around we see as a commercialization and growth challenge. But in terms of actually there's incredibly diverse and capable STEM sector, really promising networks of national research networks with really strong levels of industry integration in Vietnam, in Thailand, in Malaysia, and Singapore in particular, and have really focused on cultivating unique national strengths. So, where Singapore, is really focused on building a broad-based biotech capability, maybe moving precision fermentation, moving off of alt protein. Vietnam has really stood out in terms of the ecosystem that it's building around aquacultural health. Thailand around life sciences more broadly and translating from historical strengths in medical and veterinary science. And Malaysia primarily around palm sustainability and the ecosystem of deep technologies that supports that, an engine that helps connect that to corporate opportunities. So really interesting locus there, but also really a lot of pressure in a current funding environment and budgetary environment for these nations, which is really pushing towards real commercialization results coming out of research systems. So there you are. That's just the tip of the iceberg. Again, I want to just extend thanks to our partners and supporters on this effort, for FMO Ventures, IFC, Rabo Foundation, Omnivore, of course, the colleagues at Brighter, we're going to take a break from talking, and we encourage you to go to the landing page for the report on Omnivore's website, which will flash up with QR codes shortly at the end of the call to download this report in full and learn more, and hope that you can reach out and share your own bones of contention. But first, we're going to look forward to hearing from our esteemed panel. I'm going to hand over to our moderator, Maurice Sheepens from FMO Ventures, to introduce the panel and kick off the discussion. Maurice?
Yeah, thank you, Justin. Hello, everyone, and welcome to the second part of today's launch event. My name is Maurice Schepens, and I'm a Senior Investment Officer at FMO Ventures, and I'll be moderating today's panel session. We just had a great presentation regarding the report from Beanstalk and Ryder, and in the next 35 minutes, we'll explore what this means in practice for investors, which models work, where capital is still flowing, and how investment strategies need to evolve in this next phase of the AgTech in the region. I'm delighted to be joined by 4 investors that are deeply active across South and Southeast Asia's agri-tech and climate innovation ecosystem. I would like to ask my panelists to briefly introduce yourself and the fund to the audience. Maybe Vignesh, would you like to start?
Thanks, Maurice. Thank you, everyone, for having me here. Good afternoon from Singapore. Quick introduction. I'm Vignesh R. Pillai. I'm one of the founding partners of TMB Aura. We're onto our third fund now. We are Series A B investors in Southeast Asia, investing across Indonesia, Vietnam, Philippines, and of course, Singapore. And relevant to this panel, at least for today, we are investors in probably one of the most funded agri startup out of Vietnam called TechCorp, as well as companies in Indonesia such as Iratani and AgriAku. So looking forward to sharing with everyone our insights across different industries and different countries. So thanks, Maurice, for having us.
Thank you, Vignesh. Jash, could you please introduce yourself?
Hi, everyone. My name is Yash. I'm a partner at Jungle Ventures. We invest across India and Southeast Asia. So to that extent, have experience across both the regions we are discussing today. We're investing now with our 5th fund, managing about 1.25 billion in capital across these 5 funds, invest at the early stage as well as the growth stage, and have been part of quite a few value chain investments within the broader agriculture and related spaces.
Thank you, Jash. Marie.
Hi, I'm Marie. Thank you for having me, and I think a really wonderful report on the kind of state of agri-tech in the region. I'm one of the founding partners of Wavemaker Impact. We are a climate tech venture builder and VC. So we don't solely focus on ag, but agriculture and land use change is about 50% of the emissions in Southeast Asia. And by I don't know by design or coincidence, but about 50% of our portfolio it plays somewhere in the food and agri value chain. So some of you may have heard of Rise, our company with Temasek, Breakthrough Energy Ventures, and Gen Zero that's decarbonizing rice cultivation. We also have a company in biochar, a company that is doing low carbon feed for dairy cows. So all across the food and ag value chain, and recently started investing in India as well.
Great, thank you, Marie. And last but certainly not least, Ziv. Sorry, Ziv, you're still on mute.
Hello, nice to meet you. My name is Ivan Rogowski. I'm one of the founding partners of Right Partners. We actually started as a corporate venture builder, so we're quite excited by the report saying that corporates will be more instrumental going forward. We can talk more about that later. We have built and invested in a set of ventures across agriculture and also climate, as Marie mentioned. AgriAku was already mentioned with TNB Aura. We also have Diatani that does both farming of potato seeds and developed an Indonesian-based LLM for agri, supported by Google to now enter into Thailand and to Vietnam. So that's exciting, and a set of other ventures that we might get to touch and talk about.
Wonderful, wonderful panelists. Thank you all for joining here. Now, let's get right into it. First question for Marie. The report concludes that the decline in agtech investment reflects the recognition of structural constraints rather than weakening fundamentals. So from your perspective as an investor, what were the biggest misconceptions of the previous cycle? And what has the market hopefully learned the hard way.
I mean, I think the markets recognize a lot of things that were in the report, right? So 80% of farmers in Southeast Asia are smallholder farmers cultivating less than 1 hectare of land. So it's a very fragmented landscape. It's a very fragmented ecosystem. A lot of the precision agriculture, the data-based innovation that happens in more developed markets doesn't apply here. I think there was a little bit of a I don't know, an early stage or like 2000 internet company approach to ag in the region, which was kind of like if you acquire enough customers, at some point you can make money somehow. And maybe, profitability and unit economics were not strong enough. I think that's changed very, very significantly. I know it's a little bit a topic of discussion later on, but one of the things that we find particularly in the climate space is that ag is a more capex intensive business. I think the capital needs and the capital stack is different. And while I know the report was pointing at the resiliency of asset light models, I wouldn't say that any of our companies in this space are really asset light. And so I think one of the big changes is a recognition of the different capital stack that's needed. Again, this was brought up in the report. While I think, impact investors and DFIs play a important role in catalyzing the market, I think I think as a region, we have to get better at using debt for debt-like purposes. So I would say those are some of the learnings that we've taken away from the last cycle.
But you mentioned the capex intensity, which is more structural than haphazardly applicable. Does it also mean then that return on expectations should be adjusted?
Yeah, so it's something that again the report kind of was talking about, right? The 200 to 300 million exits kind of pathway, and I think there were some comments in the chat around whether this is really a VC industry in the traditional sense. If you can't underwrite for billion-dollar outcomes, then is VC the right capital stack? So I think those are really interesting questions. For us, because we're early stage investors and we take somewhere between 20 and 30% of our companies, because we co-found them, right? We build them. Our model is able to underwrite for smaller outcomes. But would be very curious to hear from Vignesh and Yash, because I think they might have some different perspectives on that.
I guess the moderating role has been taken over by Marie.
I know, sorry.
Vignesh, can you maybe respond to Marie's question?
Marie, sorry, was that to me?
No, I think it's just it's different for me and maybe for Ziv as well, because we're very early stage investors, right? So we can come in, we can take bigger stakes, we can underwrite for, I guess, smaller exits and still multiply our fund.
Of course.
But one of the big questions is like, who comes in after us?
Yeah. Of course. Maurice, sorry, were you pointing at me?
Yeah, Josh, please go ahead. I'm very keen to hear from you.
Yeah, happy to look. I'm not trying to give a polarizing response, but I think this has been called out in the report, a super insightful report and a very balanced report, in fact. But it is worth discussing in a bit more detail. Here's our view. We do seed and early stage as well, but we also do Series B and C as well. And obviously, there is a different lens. We look at those different opportunities at. What I would say is from the formative stages, if you are doing something truly innovative and disruptive, and innovative being the pathway you are taking to that business venture is different than before, and disruptive being there's particular aspects of the value chain which can look very different than what they used to before. If either of those things are true, you should consider early stage capital, but really you and the early stage investor, especially in agri and related industries, should understand the time required to make change in a fairly well-embedded ecosystem, and also sort of, what the difficulties may be. So using early stage capital just to hire and pay employees and possibly be margin negative just to scale products, you're not proving any product market fit with that. You're merely operationalizing the idea. and it is better to use that capital really for keeping a lean business which is still monetizing, still having some positive margins, so that you aren't constantly just subsidizing, because by the time you get to some proof point, maybe you're running out of runway. And then really, given the nature of everything we've heard, you do need a partnership with a corporate, especially if you are in the emerging technology space or possibly digital value chain, where they are your early users, pilot customers, buyers, purchasers, export partners. For that middle phase, so that series A, B stage, if I may call it that, let's say 1 million to 10 million in GMV, GTV, gross revenue, whatever you want to call it. And then really growth stage capital should be an aspiration only if you can very confidently see a path to at least a 50 million net revenue for your business. Otherwise, you would be doing a bit of a disservice to yourself, your investors, your employees, because the mismatch between growth stage investors, the amount of time they have, and the amount of failure rate which they can bear in their sort of business model often may not align with a 14, 17-year kind of end-to-end, say, value creation cycle. Your early stage investor may still be well in the money, even if it's a little bit slower, because at a, like Marie said, a 200-300 million exit, you're still well in the money. It takes a bit longer, but there's enough of a multiple expansion that the IRR still makes it interesting. So I would say it's almost early stage if you have an innovative, disruptive approach, but then really see true product market fit at the monetization and margin level to decide the pace and trajectory of your business. And if it is truly headed in that, 50 million as a baseline target, a 150, 200 million net revenue someday, then growth capital makes sense. Otherwise, I would say your customers and your margins funding your business, and then possibly considering debt capital if you are, profitable in a consistent way, and possibly some funding and grants is the way to go, at least until you're well established. The flip side is, the good news is, this is often a hard problem to solve. So no one's in a hurry to overtake you, because the problem has existed for the last 35, 40, 50 years. So, that panic of, we found this amazing idea which no one else has. Most successful investors will tell you ideas have value, but execution and staying power definitely, counts for a lot more in the longer term.
Thank you, Josh. Very insightful. Building on the question from Marie, and I'm actually now addressing to Vignesh. So in the report, it was actually mentioned that the C to Series A transition was a primary bottleneck. So according to you, what's preventing these AgTech companies from clearing this transition? Is this a founder execution issue? Is it a lack of suitable follow-on capital, which kind of was hinted on by Josh? Or is it simply a mismatch between VC return expectations and basic unit economics? Keen to hear your view.
Yeah, so Maurice, maybe I would just start off with a little bit about what do we look out for in a good deal, right? And then that's a good reflection of other Series A, B investors in the region, I would say in other markets as well. So we have a good knack of investing about 3 to 10 million into companies which are about 10 to 40 million valuation, where we take 5 to 20% stake, right? And we help these businesses get up to about that 100-ish to 200 million valuation with that equity round, right? So being a high conviction but sector agnostic investor here, we do a lot of research to understand agri. So there's a lot of founders in general who just do what they know and they are passionate about it, and they just build an agri startup, right? And it could be across so many different verticals, but we try to do research mainly just so as to familiarize with us what other business models did successfully. I think Justin or David kind of mentioned earlier, it's not because we are conservative, it's mainly because we just want to make an educated decision, And if you think about that, the value chain in agri goes across inputs, right? And then it eventually goes into precision agriculture and then farm management. And then eventually goes into traceability, outputs, and then fintech. This is mainly the value chain, right? Because Singapore is a developed market similar to many European countries, we are focused on deep tech, right? Because we are highly efficient in everything else in a certain extent. Whereas the Southeast Asian market, quite frankly, would I do a deep tech startup? Probably not in Indonesia, right? Because it requires a lot of subsidies, adoption. B2B is a very small TAM in Southeast Asia in general. So we technically wouldn't do it. But we would do inputs, marketplace, which is the business model of Lavaro, in Latam, which now AgriAku is doing in Indonesia. We would do the DHAT space, which Marie mentioned earlier, which addresses all the small stakeholder farmers and then gives them access to fintech, so financing, good inputs, and help them to aggregate so that we can export, right? I know it sounds like an e-fishery story, but it actually works, right? If people actually did traceability and accounting properly. So, so these are two, three areas that we really, really like. So back to Yash's point as well, which he pointed out, end of the day, it's all about good unit economics and performance of a company when they come to A and B. When the market has plenty of capital, like pre-2021, where it was at the highest in terms of Southeast Asia getting investments, then of course you can pursue loss-making models to gain market share. But you have to be realistic as an entrepreneur. Right now we have had probably a slump over the past 3, 4 years, especially as Southeast Asia. So you need to take a more conservative approach. So to answer your question, yes, Southeast Asian VCs in general are finding it difficult to fundraise as Series A, B guys. So the market is very shallow, right? So we have to be picky too. So as an entrepreneur, you need to be thoughtful about what is the precedence, your unit economics, be conservative, don't be loss-making. Like what Yash mentioned when you come to A/B track. So that it's clearly product market fit, right? And then you would have probably guys like us and others backing you at A/B. And that's what happened with Tech Co-op. Just to give you a background, it is the exact Iratani model in Indonesia, but because Vietnam is behind the curve, we backed Tech Co-op early, but they were profitable from day one because the market was very different. As you would know, FMO is on the cap table now, but I think time changes you to be more disciplined, so that's what we look out for.
Yeah, thank you very much, Ignition. That's very insightful, and it would be great if all companies would be profitable from day one. Obviously, that's not always the case. And an interesting point, actually, and that's a question I would like to ask to Ziv, relates to the digital value chains, right? On the one hand, the report mentions that this is an opportunity. At the same time, when we look at pre-22, most of the funding actually went into digital value chains. And then, of course, there was a sharp correction afterward. So according to you, Ziv, which models in the digital value chain play are still investable today, and which ones you should really stay away from?
Okay. So I like the report a lot for the structure, but I would also always urge that there is some nuance in the structuring. So, and as an ex-consultant, it's very easy to put life into the structure and decide that that's end all be all. When you call digital value chain, I actually think that that means many, many different things, right? Traceability is a digital value chain. A marketplace is a digital value chain. A set of other things are as well. The important for us, and this is why even we mentioned AgriTech a couple of times, so I'll give you a bit of a sense of how it evolved, right? As such, is that are you solving a primary pain point, right? And we hear a lot of pain points a lot, but I think after interviewing hundreds of people when we're trying to bring in the right people to our team, we recognize that that definition is not always so clear. So let's define for now a pain point as being something that if you solve for a customer is actually willing to pay you to solve it. And that's a very, very important thing, right? Because otherwise, when we always talk about pre-2021 or 2022, there was a lot of eyeballs, but there were not a lot of pain points being solved, right? If the digital value chain is solving a meaningful pain point for a meaningful customer, then it makes sense. Now, it's sometimes easier to start with what is not a real pain point, right? So we talk about traceability a lot. I have a lot of questions. One, because there are startups trying to do it. Two, because while Europe always claims traceability, they are not very good at giving the value of traceability back to the farmers that are supposed to create that traceability, right? And so that, for me, is not necessarily a valuable, digital value chain as an exercise. AgriAco itself evolved from wanting to provide services to the brands, to the principals, to recognizing that that is very, very difficult because the brands don't want to give up control for a digital marketplace or digital value chain. So they actually pivoted into developing their own brand as such. So again, the question is not what is the right digital value chain, but are you solving a real fundamental pain point? So in the AgriAco case, instead of trying to solve a pain point for the principals, they're more moving towards solving a pain point for the farmers themselves by giving them a better product that is white label. And that is essentially the way to go.
Thank you. And it's also interesting to hear indeed how difficult it is to actually define a certain category. It can be very broad. At the same time, sometimes it's quite easy, and it's actually a question to you, Josh. The report makes a distinction between two types of crops, right? Basically, it's the staple crop on the one hand, which is small or lead, and on the other hand, you have the basically export-worthy commercial cash crops. In your view, these two segments, do they require like different capital structures and also investor types of investors? And if so, how would then a VC, a DFI, and a corporate each act?
Yeah, I would say, look, as the report called out, the export-oriented value chains tend to be a little bit more professionalized just because you are doing business across countries. You often acquired certain customers, you have a certain longevity with them. There's also a more limited role of sometimes regulatory or government-based pricing or input-related dynamics, which are to be dealt with, sometimes even sourcing of inputs, etc., and the likes. So for that reason, the export-oriented businesses are a bit more private sector commercial in nature. Some of the staple ones could be as well, but they may or may not be in some cases. In the export-oriented ones, again, it is still a commodity. There is still a certain pricing and FX risk involved, but you've been doing business. If you've been doing business for a slightly longer period of time, then it becomes a bit easier to underwrite because the retention and continuity with certain customers can be analyzed in a sort of more straightforward way. Those fit well with the venture value chain, I would say. And that's why you've seen historically more of the investments in the marketplace part of what digital value chain as they've defined it. Now, obviously, even within that, if you try to scale a marketplace too quickly by bringing in any flow of GMV, GTV without adding much value to it, that's when you basically become a subsidized logistics and working capital risk taker, which every commodity cycle will always turn, and you hope it turns later, but if it turns sooner, that's when you end up on the short end of the stick. So I would say export works better for VC also at a slightly more mature scale. It tends to be also higher ROE, and therefore you can scale a bit larger before you need a larger amount of equity investment, unless you have a sort of working capital cycle to deal with. Staple value chains are obviously quite sizable. I would say if you're focused on the domestic side, then the report defines it well. I would say sustainable brands is a good space to focus on. And you may not do business with North Asia or Australia or Europe, but you could still do business within Southeast Asia. And there's quite a few farmers, but there's also quite a few affluent people now in the market who are focusing on the organic quality of what they're consuming, who are keen on the freshness and the time from farm to table. So I would say if you're focusing on the domestic value chain, maybe focusing on a slightly more discretionary and price insensitive product value chains, if you can, is a good way to go for investors. Just because again you are building a slightly deeper customer connection before you work deeper down that value chain. Capital wise, again, I do think that in the middle stages, and middle I define as series A plus B all the way through series C or D, you should by then have enough handle on your operating margins and to some extent capital structure that you are able to access some form of debt capital, or even if it is corporate pilot programs or certain prepaid revenues or grants, you're able to have a slightly more diversified capital structure. I think that would be the way to go. Early stage, no one would give you debt, and therefore a grant or sort of early stage equity works better. But again, keep it lean, keep it really just focused on finding PMF as opposed to scaling just for the sake of.
Yeah, absolutely. And I think venture debt by itself is a very important topic, but I guess we'll park it from now for this discussion. But I do want to move a bit forward on this particular topic between, let's say, the staple crops and the cash crops. And so, Vignesh, for you, one of the points highlighted in the report is obviously the productivity gap, right? Even 2 to 6 times less compared to other markets. Where do you see the most room if you had to focus, right? Rather look at productivity-led solutions in the staple crop side, or would you rather say, okay, we look at the higher value crops and then we look at premiumization as a value pool?
it's a combination of both, right? Because if you are just purely productivity led and you have some sort of a solution which is, hey, could give you a much better yield, right? The farmer is going to tell you, I have no capital to adopt your solution, unless if you go to a big corporate to prove the solution. So I do think it needs to be a combination of, yes, solving productivity, but together with every other element of financing and also even digital value chain and traceability and several other solutions, right? So I think naturally everyone is focused on productivity, but there's several ways to address it. It could be by just providing better inputs with financing. Instead of financing, you just give them better inputs, like what many of these companies globally have done. And from there, start then managing the farms and advising the farms with their own internal teams, right? So we've seen this in Indonesia with Iratani, as well as with TechCorp now recently in Vietnam. Of course, Philippines, you haven't seen a player emerge yet who's very focused on farmers themselves. But that's where we see. So I think it needs to be a combination of everything, right? I think you can't just be a productivity solution and how you're going to scale, how large is your market, addressable market, and so on. Yeah.
Okay. Thank you. Yeah, that's absolutely true, right? And then that makes it always challenging to look at what's the best way. There's not the best way, right? It really is the opportunity at hand.
Yeah.
Actually, I want to circle back to one of the comments made by Marie earlier this discussion, which is about capital intensity. And I fully agree that most in the agri-tech space, we see more CapEx intense business models versus the asset light ones. At the same time, right? One is it, at what point in time is it a strategic asset? And at what point in time do you get into this more like fatal capital intensity space?
Yeah. If I could just add on this capital management bit, I know a lot of people talk about something being heavy capex versus something being too asset light. It's actually a weird thing. If I give you an opportunity, and I'm not sure if you're familiar with the largest developer in Singapore, which is Capital Land, right? And if you're given an opportunity to invest in the holding company of Capital Land, though their projects are billions of dollars, would you or would you not do it? Of course, you do it. The first two projects is capital intensive, and there's more equity required, or you need to create an SPV to manage that first project. But eventually, you would get debt with track record, right? So we have seen this for agri, for example, in both Indonesia and Vietnam. Once you've hit a certain scale, right, above 5 million US, even the banks are now focused on lending towards it, right? And to enable that industry. Even if you look at Singapore, recently DBS announced a green loan program, right, which is focused towards potential asset-heavy EV infrastructure businesses, for example, to build this infra. So I understand that certain business models are capex intensive, but if you approach it with an educated manner where, hey, after a certain scale, I'm going to replace that capex with debt instead, that helps, right? That obviously opens up the conversation of venture debt, which I don't think is good. It's very expensive. But you want to build it up to a certain scale where you get traditional bank loan, right? And Southeast Asia now, because we have obviously been doing this for the past 15 years, the banks have matured up, right? To be like, hey, for some of these companies we show track record, we're going to provide loan. So yeah, asset light, asset heavy, you can be asset heavy looking and become asset light slightly later,
Yeah.
by spinning off your assets via REIT in our EV infra business, via just replacing it with debt. So several things, right? Because if you want a bank to give you debt, you need equity, and better unit economics. Yeah, so I'm a fan of both models as long as the end goal, they achieve operational excellence and execute what they put on the BP. Yeah, it works.
Yeah, no, and just one quick response to it, right? Often you see that fund managers have a generalistic approach, right? It's not just agri-tech. And if you then, agri-tech is not by in isolation, and you have to compare it to fintech or some other e-commerce place, then, the capital intensity does come into play. But Marie,
Yeah.
what's your view on this?
Yeah, it's actually quite similar to Viknesh. I guess the additional layer for us is we launched with a mission to build a portfolio of companies that could abate 10% of the global carbon budget. Every company we build is what we call a 100 by 100 company. So it has to have the potential to abate 100 million tons of carbon dioxide equivalent and be a $100 million revenue business at scale. And so, carbon is physical, distributed, and embedded, which kind of basically means you got to change the real world in order to have a direct impact on emissions. There are always exceptions, but particularly in the ag space, I think it's very difficult to shy away from either working capital needs, inventory needs, capex, like pure capex needs. So, for example, we have two companies, one in Indonesia and one in India, that is turning agricultural waste into a drop-in replacement for coal. And when we looked at this, I guess the traditional like sort of coal power plant model is very centralized, right? So you need to spend 10, 15, $20 million on a central facility because scale matters. But I think given the landscape of smallholder farmers in the region, there's actually an opportunity for decentralized kind of capex plays, right? So instead of spending millions of dollars on a pelletization facility, you can spend 30K on a facility, co-locate it right next to a customer, reduce your logistics costs. So I think there's lots of exactly what Vignesh said, right? I think there's lots of opportunities to think differently about capex requirements, and then really know the role of debt. And I think the more and more our founders and their management teams are aware of when you should be raising debt, what debt looks like. I think we've seen that there are more providers who are willing to come in and provide early stage debt, not necessarily venture debt, but more kind of catalytic or impact kind of focused, with the intention that to build a track record of companies so that they're able to qualify for debt. So Rise, for example, is working with Temasek Foundation, where innovative structures that leverage banking capabilities but provide guarantees. So I think there's lots of things out there that are now possible. But what it needs is a company to recognize the role of debt or working capital in their business model, and to engineer for that from day one.
Thank you, Marie. And then Ziv, you mentioned earlier as well, right? So you work closely with corporates, and I think that part is not really highlighted in this panel discussion so far. What kind of role do you see for them?
Good question.
To Ziv,
sorry.
question.
Sorry, go ahead, Ziv.
Okay. Yeah, so I think there's a couple of things, right? So just to give you a sense, and that's why this report is quite interesting from that perspective. When we started Right Partners 5 years ago, and the idea was to put some of our portfolios on a panel like this and say they work with corporates, we were told not to, because it would scare away the VCs. The fact that now there is the ability to kind of find ways to do it, to be fair, the corporates have also matured since then, and also how we do, right? Why are corporates relevant? Because they have their own reasoning to de-risk some of those early investment. And to be fair, there's a nice arbitrage there, because the return that they're expecting is not the same return level that VCs do. Just by virtue of their IRR targets are much lower, because they're comparing it to a business. If we get really lucky, and again, this is what, this is important, because not all corporates operate the same when they work with ventures, then the corporates are able to deploy quite a bit of their unfair advantage, if you will, or a set of capabilities that are helpful, right? And we see that in quite a view, right? So I mean, again, I keep going back to AgriAku, because I think it's a good example of both working with a corporate, right? So AgriAku actually started on one level by wanting to solve Jaffa's, inputs to increase the yield for corn. To be fair, they moved well beyond corn system, but there was at least a reason to do this, and this is where the family started to build AgriAku. Since then, they actually proceeded to seed a set of ventures that are collaborating with AgriAku, right? As such, right? So the family has, which one of them does the farming aspect, which is Diatani, another one does biostimulants, and creating that ecosystem is quite important. I think so. Sorry, long answer to a short question. But in reality, where does corporates come in? I think level one is they can come in with capital that are lower costs than what is the capital for VCs, right? By virtue of return. Two, they come in with some of those unfair advantages, right? And capabilities to leverage. Three, they are very instrumental in creating ecosystems, where I think one of the big changes that we also haven't discussed from 2022 to now has been that before everybody was talking about a full stack. I need to do everything, right? Actually, the funding mechanism didn't end up being very good for full stack. And so what we see more and more ventures, they're focusing on one part of the value chain. I will solve X, or I will solve Y very, very well. I'll get to profitability. I'll scale that part with that. Corporates are very good at actually convening those different parts of the value chain together and kind of patching them together to create a much better solution.
I just want to double click on what Ziv said, right? So,
Very quickly then, Vignesh, please.
yeah. In earlier days, we also used to joke that, hey, if you get backed by Singtel, that's the end of you. It's because you just get eaten up into the corporate ecosystem and you have so much of stuff to do just serving that corporate. But nowadays, depending on the industry, and I think more than corporate, I would say families, right? In the more domestic ecosystem like Indonesia, the Jaffa guys, or in the Philippines, the Aboitiz guys for power, right? I think partnering up with some of these families does really make sense for us. So it depends on the industry, the type of corporate, but I get where Ziff is coming from, from
I agree,
these.
Vignesh. There's a lot of corporates that are difficult. Yeah, so I fully agree. Thank you. Yeah.
Yeah.
Now, thank you for highlighting the importance of such partnerships. Hey, I see that we're getting towards the end of this session. I do want to ask one question to all of you, and that is looking ahead 3 to 5 years from now, which subsector or market in Southeast Asia are you most bullish on? And of course, what needs to go right for that opportunity to scale sustainable? Maybe Marie, would you like to start?
Yeah, I think it's waste valorization, waste to energy, anything that is a drop-in replacement for existing energy or fuel or material.
Very clear. Josh?
Yeah, I'll repeat myself, but I think high quality agri produce and sort of sustainable consumer brands, I think have a long way to go. People are being a lot more mindful about what they're consuming and where they're sourcing it from. And most of it was export oriented outside of Southeast Asia and India. But the demand within these domestic economies is growing a lot as well. So I think that's quite an easy and obvious opportunity in our opinion.
Thank you. And Ziv?
We follow less trends. I'm much more interested in finding within every single value chain what is the pain points that is most worth to solve. So I think if I could say that the emphasis would be, and especially now with AI tools and other research, we can get better understanding of what problems are there to solve that are worth value. That is for me more important than this industry or this market.
Yeah, great. Hey, and Vignesh, for you.
Okay, so way wider answer, yeah. So like what Justin showed earlier, every different market in Southeast Asia looks like there's different opportunities and different focus. That's cause of patterns, right? Different market is in different maturity level of funding. Like for example, whatever you saw in Indonesia, now you see it playing out in Vietnam. Next will be Philippines. So business models across different industries will still have opportunities, but different markets, right? And also in terms of Singapore, for example, we look at deep tech, that's because we're a developed market. So we obviously are looking at deeper frontier technologies. So I think we all have to take note of maturity of each of the countries. They are not one country as Southeast Asia. They're all different, and the maturity of different business model in each of this market. And there's opportunities everywhere, right? Yeah.
It's a great way to end this panel session. I would like to thank you all for your participation and sharing your views, your experience, your perspectives. It's very insightful. And I'm going to hand it over to Mark for the closing words of this event.
Look, the closing words of this event are, thank you all for joining us. Thank you Maurice, for a wonderful panel that really tackled some of the harder hitting issues here. Thank you to Brighter, and Beanstalk for the terrific work they did on the report. Thank you to FMO Ventures, IFC, and Rabo Foundation for their support in making this report possible. And I think we all leave, excited and cautiously optimistic about the region, but smarter about how we're going to invest in it. So looking forward to seeing what we all do in the coming years. Thanks, everyone, and enjoy the rest of your day.
Thank you all.
Thank you all.